Alright, welcome everyone. This is Scott here again with a new video to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And for today's video here, I'll be explaining the technical or statistical definition of implied volatility. Right, if for example you have seen my other YouTube videos about implied volatility or the videos where I've mentioned it, up to this point I've been explaining implied volatility simply as the market's expectation of where a stock will be in the future. And conceptually speaking, that is correct. This chart down here, for example, which I've shown many times before, provides you a one-year time series of the implied volatility for, in this case, Marvell Tech Group, which is a chip manufacturer. And so as you can see right now, the implied volatility for Marvell is just over 48%. So as a recap, this means that 1 year from today, the expected price range for Marvell is either up or down by about 48%. And obviously this number here can and will change on any given day based on what's happening in the market. So like I said, conceptually speaking, that is a great way to understand what implied volatility is. I think it's a pretty simple definition. But the full definition of implied volatility does go deeper than that. And this is something that is very important to understand as an options trader, especially if you trade based on probability like myself. Now before I continue here, for those of you who are new to the channel, I just want to let you know that I do also teach on SKILLSHARE, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check those out, and when you sign up for SKILLSHARE using any of those links, you'll get a 2-week free trial. And so now if I come over here, this is where the true definition of implied volatility stems from. And don't worry if you've never seen this curve before, or if it looks rather complicated. I'm still going to explain all of this in a rather simple fashion here. But perhaps if you have taken a stats course in the past, then this curve might look familiar to you. And so this is called the bell curve, or the normal distribution curve. And it's simply used to model random systems, like flipping a coin, rolling dice, or modeling the stock market. And that's because stock price movement, for the most part, is very random. Whether stocks go up or down on any given day really is the matter of a flip of a coin. And I actually proved this in one of my SKILLSHARE classes. And that course is called Options Trading, Understanding Market Behavior. And again, I have links to my courses in the description of this video, that one included. So with that being said, you can use the bell curve here to model the stock market. Now the stock market is not a perfect random system, so it's not going to conform exactly to this curve here, but it's definitely pretty close. And so the main point, the main takeaway from this is that if you are able to model a random system using this curve, then you can use this curve to make very accurate predictions about the probability of something happening in that random system. So in the case of the stock market here, you can use the bell curve to provide a pretty accurate estimate of the chance or the probability of some stock being within a certain price range at some point in the future. And so the final piece of this bell curve that you want to understand here has to do with standard deviation. And that's what you see on the x-axis down here. You can see down here we have some integers and also some Greek symbols. And specifically this one here is sigma, and this one here is mu. And so in this video here, I just want to focus on sigma, which represents standard deviation. And so all that you need to understand about this chart here is that within a 1 standard deviation range, between -1 sigma and +1 sigma, anywhere in this range, the chance or the probability of something happening within this range is 68%. I'm just adding up the two 34% here. And so when I apply this to the stock market here in a second, these sigmas are going to represent stock prices. So that would mean the chance of some stock landing within a 1 standard deviation price range would be 68%. And now if you look at a 2 standard deviation range in between -2 sigma and +2 sigma, the chance of something happening within a 2 standard deviation range is about 95%. Again, I'm just adding up all these percentages here. And then within a 3 standard deviation range, between -3 sigma and +3 sigma, there's about a 99% chance of something happening within that range. And it does continue on from there. A 4 standard deviation range, 5 standard deviations, so on and so forth. But given that there's a 99% chance of something happening within a 3 standard deviation range, that means you really do not need to focus beyond a 3 standard deviation range. So what does all of this have to do with the stock market now? Let's come back over to the charts here. And so like I was saying, the implied volatility for Marvel right now is just over 48%. So specifically now, the full scope definition of what this means is that 1 year from today, the one standard deviation expected price range for Marvel is either up or down by 48.65%. Right? When you look up the implied volatility for a stock, it is going to be the one standard deviation expected range. And also when you look it up, it will typically be quoted on a 1 year time frame. That's why I said 1 year from today. But you can definitely take the implied volatility and convert it into any time frame that you want. If you want to see the one standard deviation expected price range over 1 day, you can do that. Over a week, absolutely. Same thing for a month, 1 year, 2 years, 5 years, etc. And the cool thing with the ThinkOrSwim platform is it will do all this for you and show it in a very visual way. So let's come to the Analyze tab now. And here in this chart, you are seeing the one standard deviation expected price range for Marvel over a variety of time frames. So you can see on the x-axis here, this represents the number of days out in the future, either 10 days, 20 days, 30, 40, so on and so forth. And also, these brown dashed lines that you can see right here as well, these are marking the expiration dates of the various expiration cycles for the Marvel options. So for example, if I wanted to see the one standard deviation expected price range for Marvel stock by May 14th, 2021, which is about 26 days from today, I believe, then I just come up to this curve here, and so this means, and you can see the number right there, that Marvel could be as low as $41.52 or as high as $54.14 by that date. And so now the final piece of this is that given this is a one standard deviation expected price range, there is about a 68% chance, a 68% probability that Marvel will indeed end up somewhere within this price range by May 14th. And so that also means there's about a 32% chance that by May 14th, Marvel could be beyond this range. It could be above $54 per share or below $41 per share. So that is the full definition of implied volatility. It's the expected price range of some stock at some point in the future, like I've been saying all along, except until now in this video, the final piece that I added on here is that with that expected price range also comes a probability that the stock actually does end up within that price range. And you can use this graph to go out as far as you want in time. Right now it's going about 80 days in the future, but I can just click and drag on the x-axis here to go out much further in time. Now it's going out to 200 days in the future. And so now this means 200 days from today, there's about a 68% chance that Marvel stock will be somewhere between about $64 per share and $31 per share, somewhere within this range. And then finally here, the last thing I'll show you in this video is if I wanted to see a 2 standard deviation range on this chart, so that way I can see where Marvel will end up about 95% of the time, I can just go up here, click this button, and just go to the plus or minus 2 sigma button here. Click on that, and now as you can see, anywhere on this chart will show me a 95% chance of Marvel stock being within a certain price range. So as a final example here, if we look out 40 days into the future, all the way to the May 28th expiration date, there's about a 95% chance that by this day, Marvel is somewhere between $65 per share and $34 per share, anywhere within that price range. And so there you go. That is the full scope technical definition of implied volatility. I definitely understand this can be a complicated and perhaps confusing subject, so if you do have questions, please do let me know in the comment section below, and I'll be happy to help you out. And don't forget, if you want to take some very in-depth classes on options trading and stock market investing, then check out my SKILLSHARE courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every Monday, Wednesday, and Friday, and you don't want to miss out. So thanks again for watching, and I'll see you next time.